Hit it.
It's Friday, September 19th, 2025, episode 274. I'm Patrick Ceresna.
And I'm Kevin Muir. Patrick takes some crayons out of his mouth to make sense of this topsy-turvy market we're experiencing. But before we do that, a quick announcement. After 18 years at the same price, Patrick has finally decided that inflation might be real and is increasing the price of his big picture trading membership. So Patrick, on October 1st, I hear your prices are more than doubling from $948 to $2,000 a year. $2,000, man, you're getting expensive.
That's why we set this up, because until September 30th, listeners can still get in at the old $940 rate.
So basically, if they want to apply all the great ideas that you talk about on this show, this is the cheapest way?
Yeah, exactly. And to make this a no-brainer, it's 100% risk-free for 30 days. You can try everything. And if you don't like it, you can cancel and get your money back.
All right. You heard the man. Go to bigpicturetrading.com/new prices before September 30th. After that, you'll need deeper pockets.
All right. Well, let's get Danny on the show. Danny, what beer are we drinking this week?
Right. Well, this one's close to Kevin's heart, maybe, but this one's called Who's a Juice? Hold on. Let's see if it.
It's not. Okay. So, whoa.
Have I said it right?
Hoser?
Hoser?
Oh, it's Hoser. Oh my! We know who's not the Canadian in the group, right?
Guys, I have no
idea.
idea.
It's a hoser.
That's juice.
Yeah, hoser. Eh?
Okay, so this one was actually made when the tariffs situation was happening. So they don't sell it in America.
Okay.
And yes, and by Patrick's face, it is 10.8%.
Wow.
So it's a bottle of wine.
Hey, you know what? I thought it was going to be terrible. It's actually not as bad as I thought it was going to be.
It is. It punches you, though.
Yeah. And by the way, we are upping our game. We finally got the beers. We figured it out. Patrick's got them in Portugal. I got them in Canada. Hoser Juice, triple IPA. Not as bad as you would expect.
No, I think it's pretty good. And we had a delivery come from Canada yesterday, so there'll be plenty more of where you come from.
Absolutely. All right. So, Kev, why don't you give us a disclaimer here, buddy?
Sure. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the neutral rate nostalgia syndrome, the liquidity trap trauma, and the soft pivot paranoia.
Yep. That sounds like a, yeah. All right. Let's get the guests on.
All right, folks, this is something I've looked forward to for a long, long time. And a big thanks to our mutual friend, the Canadian semi-retired, what should we call him? Ex-mining executive, ex-sell side guy that put us in touch. But anyways, without further ado, I just want to introduce Vincent Daniel and Porter Collins, both from Seawolf.
Great to be here. Thanks for having us on.
Oh, it's going to be a lot of fun. And listen, for those who don't know, they are obviously of the Big Short fame, but I promise to not ask. I figure you guys must get so many talks about it, so many questions. I promise to not ask a single question. So if you want to know about their involvement in that, go find some other podcast, find something else. But in the meantime, we're going to get to know them for the people they are, and we're going to learn a little bit more about them before their big fame. So why don't we start with Vinny? Sure. Why don't you were telling me a little earlier about where you're from? How did you get in the business? Give us your how you got to this point.
Sure. I was born as I was telling you, Kevin, prior to hit the recording, I'm a New Yorker through and through. I was born and raised in what we like to call the outer boroughs, Queens specifically. I went to school in upstate New York at the now True State Ivy Binghamton University, and I studied. And I studied accounting because that was the best way to get a job. And when I left, I was an auditor for 2 years, got my CPA, didn't like it at all. And I had a friend that I went to school with, my friend Rich. After about 2 years, we decided to have a dinner and say, who made the better choice, me or him? I went into auditing. He worked at Oppenheimer at the time.
Okay.
And it was clear he made the better choice. And he, thankfully, and I'll give him credit, got me an interview to work for, and eventually I worked for a fellow by the name of Steve Eisman, and I was Steve's junior covering the financial services vertical. And this is where we grew up. That's the sandbox that Porter and I were in for quite some time. And specifically, I covered specialty finance, which are all these gobbledygook non-bank companies that lend money without a checking account or without non-interest bearing deposits. And I was covering the subprime mortgage entities back in 96, 97, 98. And I got to see during one of the greatest tech booms of all time, my entire sector go BK, which is quite interesting. So I guess that probably was one of the reasons I became a little bit more cynical and bearish than the average Joe. And then from there, I started a boutique research shop with two guys. We tried to go independently. 9/11 happened. I joined a firm called Keefe Bretton Woods.
Yeah.
That is, again, a sector specialist in financial services, covering the same thing as lead analyst. And then after that, about 2 years, I joined the buy side and joined with Porter Collins at a firm called Front Point. Steve Eisman was the PM. We were the junior partners, and we ran a long-short financial services fund. And that's kind of where our name starts to get known because of the thing that you weren't going to mention, which was the big short side.
Okay. How about you, Porter? Walk us through your career.
Well, I was I'm a New Yorker through and through as well. During COVID, I picked up and moved to Texas, which I currently live.
Oh, wow.
And but I was a former Olympic rower, world champion, and I went to undergrad at Brown University. And I got out of college. I was an analyst at Goldman Sachs for a couple of years. But I had a roommate whose father was a short seller. And for some reason, I got a bug that I always wanted to go to a hedge fund. Okay. And so I got a job at a place called Chilton, and I was covered the retail sector for a couple of years. And then eventually I worked for Steve Eisman at Chilton as he and I both doing the financial services. And after a couple of years, we decided to pick up and leave. And that's where I met Vinny. And we ran Front Point for a while. And then in 2011, probably, we started Seawolf, and that's where we have now. And in 2020, Vin and I essentially became a family office, and that's what we do now. We're much happier. We don't have to deal with clients, people annoying us, all sorts of stuff. And the funny thing is our returns have improved a fair amount. Well, a couple of different things. We can get into this, but I think the hardest part for us was, call it 2015 onwards, doing financial services, because they basically essentially neutered the financial services sector post 08, right? Yeah. And if you weren't in tech, it was hard to beat the market.
Yeah.
And so and running a low net strategy or lower net strategy in financial services was not the way to make money. And so we sort of felt liberated once we got out of that world.
Got it. Okay. Before we get on to the markets and stuff, you mentioned, first of all, that you are moved to Texas. You're a New Yorker through to through. What has that been like?
It's been interesting. Once you get out of New York City, you think that, young kid, we thought New York City was the financial center of the universe. And you come to realize that it's actually not. And, Warren Buffett's been doing his thing in Omaha for years. And, especially now with the internet and Zoom, and you can kind of do it from anywhere. And I actually like working out of this time zone a lot better. It starts earlier, ends earlier. I think mountain time would actually be perfect for me, but
are you a golfer? Is that why you like the time zone?
Just the market closed at 3. Who doesn't like all that free time in the afternoon, whether to exercise or do whatever. So, and
just a little bit, can you tell us about your rowing? You mentioned
sure. I was in the 96 Olympics in Atlanta, and I was 20 years old at the time, and we finished 5th. We went on a couple of years after that to be world champions. And then in 2000, the coach kind of made a tough mistake where he split the boat up to try to win 2 gold medals. And
he's greedy. He was
greedy. And we both boats came in 5th. So that was a tough one. But no, my athletic background comes into play, I think, in investing, just the consistent nature of it, right? And being, just the grind of it is very similar to the grind of practicing every day and working out every day. And so that for me is very familiar.
Okay. So let's get into some views on the market. And Vinny, I'll start with you. I was watching some of your previous interviews, and you were talking about how this administration, and this was before kind of this Liberation Day, this was earlier in the year, you were talking about how this administration seems to be trying to rearrange the economy from Wall Street to Main Street. And I was wondering, since then, we've had a lot of things that Wall Street seems to be winning again. And I was wondering, has your view on that changed? Where do you stand? Why don't you explain to us how you think that element about what you think Trump is trying to accomplish plays into your view about the macro world?
Well, in many respects, I think at least the narrative of what Trump wants to do, right, is give more towards his base, right, and take away from, give more towards labor, take away from capital. Right. But I think the problem that he ran into was if and when you try and do that, and the markets don't like it, but at the end of the day, his report card, like any president, but it seems to affect him more and more than most, his report card is the market. So as he tried to pull this, let's call this austerity gambit, like the Volcker Reagan, let's kind of slow down the economy, get rates low, and then rearrange the decks, the market vomited. And maybe it was a function of his delivery of tariffs. Maybe it's tariffs himself. I don't really care. All I know is that the market sank, and more importantly than just equity markets sinking, bond yields rose, right? Which to me said, and I know you guys we listen to your podcast all the time, so this is probably, it's probably a bad echo chamber, but to me it said, holy shit, we're acting more and more like an emerging market. I don't know if that's true, but all I'm saying is we are. And Besant being Besant, that was probably not the script he wrote when he designed this and said, we got to stick the heroin needle back in the arm somehow, some way. So what we got from there was a suppression of volatility. We could probably talk about that at some point, which helped, of course, all things paper and less things Main Street. And along with this one big, beautiful bill, which I think is more designed for Wall Street than for Main Street for a host of reasons. So it's pretty much the same thing that we had prior to the Trump administration, which is more markets oriented and less Main Street, with the narrative that we're going to be helping out the average Joe.
Right. Porter, and Vinny mentioned there, he says that the big, beautiful bill is more designed for Wall Street than Main Street. When I would originally talk when Trump became president, and I looked at his policies and I highlighted the fact that if he truly wants to get, let's just say, the trade deficit down, if he truly wants labor to win, all of these things were negative for the stock market. And the pushback that I got from a lot of smart folks was, sure, Kev, those are the things he's talking about, but at the end of the day, he's not going to actually do them because he's not going to, at the end of the day, he is a Wall Streeter, not a Wall Streeter. He's a real estate guy, but he's a rich guy. So he's not going to choose the regular folks over Wall Street. Do you think that he's chosen Wall Street over the regular folks?
Well, let's rewind the clock here. Vin and I are financial services guys. And if you're a financial services person, you intently look at interest rates, right? And so we would study the Fed, every move, everything. We did this for, 2 decades. And so if you rewind the clock to the first Trump presidency, gold was sitting there at $1,200 an ounce. And what you saw was him badgering the Fed to lower rates every single day.
Yeah.
Right.
He couldn't putt. Powell couldn't putt.
people just forgot that he did this, but it was, by the time the first Trump administration was over, people were just so tired of the volatility. Like, just give me anything but this guy. And so, and towards the end of his, Trump won, the gold price started to go up, and then COVID came. Obviously, the money printing started, but then come Trump 2.0, everyone thought he was going to be austerity. A good friend of ours was long a lot of gold, and he sold everything and he put it into zero coupon bonds because he believed in Doge. He believed in Trump, that it was going to cut the government, and finally we'll have this beautiful balanced economy and everything's going to work out.
Wow.
And we Vin and I looked at each other and we're like, no, I don't think that's the case. If you look back to Trump 1.0, that didn't happen. And so thankfully we held on, and we've had over a third of our portfolio in gold and gold miners, mostly gold miners. And so obviously it's worked out pretty well for us here. And we try to be contrarians, and we look at ourselves and the stock prices of the gold miners these days, and we don't quite know what to do with ourselves and the positions. But for now, I just don't think I don't think it's stopping. I don't think the austerity is stopping it, or starting again. And if you look at the same things happening in China, it's just they're debasing your dollars every day, and they can't stop it. Trump tried to stop it for 6 weeks, and he went the other way.
And I'll let either one of you answer this question, but I recently had a subscriber reach out to me, and he was saying, like, I don't know what to do. I've been long these gold miners forever, and they've done so well, and it feels like the sentiment has changed so quickly, and they've run so far, and I want to sell some, but I'm kind of perplexed because what do I do with my money? And they've gone so far. Like, how are you guys dealing with this problem? And I use the word problem with quotation marks because it's a good problem to have, about being long these gold miners and having them finally awaken. Are you just taking a longer term picture and saying a year from now they're going to be higher, so I'm not going to think about trading them?
Well, the answer is, for the most part, yes. Although when certain names get crazy high, we start just trimming a little bit on the average. So I like to, if the RSIs get to like 85, and they have on some of these names, you say, all right, let me sell 5 to 10%. Let me make it feel like I'm doing the smart process.
Right.
But I will say, like, if you've asked us for the past 4 or 5 years, one thing we are steadfast about, and for all you bears out there, right? And our default mechanism goes to being bearish. And again, it probably comes to what I saw in the 90s. And when you cover financial services and you see how the sausage is made, you generally have a cynical eye. But we found one of the great things about not doing solely financials and being more of a generalist is we have found a way to express our bearishness, and it was really gold, right? And I guess smarter people found, I think you guys say that the asset class that shall not be named, which is Bitcoin.
Right. You are a listener. You're showing here. Absolutely right.
I told we are avid listeners. And so, but like, to us, the one thing we're completely, it would take a mountain of good information for us to get away from our thesis that at the end of the day, debasement's the only thing they can do. That's what they're going to do at the end of the day. They're going to debase the currency, and it's a global thing. So as a result, if you believe that, and we do, then maybe not the next 10%, because I could see gold trading off and the like, and the wiggles and your crayons that you guys use and all that other stuff. But for the next 3 to 5 years, it's hard and very difficult not to see debasement, and therefore, why shouldn't you own gold? So we're trying to manage through this champagne problem that we seem to have right now.
I like that. I'm gonna write that down, man.
And the dangerous words of this time, it's different. If you again rewind the clock to how these names, the biggest one, Newmont, back a decade ago, the balance sheets were completely flipped, right? The debt was very, very big, and the cash was small. And now, pretty much every stock in this sector is in close to net cash or swimming in cash. And that's the difference. And the entire commodity complex during COVID or during the last 10 years has looked at death and no capital flows whatsoever. All the capital flow has been going to tech. And if you look at these tech companies, they're starting to look like, capital cycle companies with all this CapEx coming in right now. Right. And so it's very interesting to us. And the big one we had was an Eco Eagle. It was the cleanest, in 5 years ago, it was the cleanest, best balance sheet. And, we don't see any change from that right now. So
I got it. Let's talk a little bit about that AI, because you brought it up, and you rightfully have highlighted how in the past, like the tech was the capital light industry. That was the one that was like, that was the reason you owned it, was it was a capital light industry and it was doing so well. Now all of a sudden we've had this switch where all of a sudden all the capital is going into there. And, our mutual friend, Cuppy talks about the fact that it might even be larger than we think. Where do you guys come down on? Is this a bubble? And, is there a way to take advantage of what potentially could be a very exuberant and oversupplied market?
Well, there's so many ways you could take advantage of it, right? In our view, and the way that we're value guys at heart, right? We're contrarians at heart. So us going out and buying the latest meme AI craze, don't look for us for advice on that. We're chances are we're probably trying to short it rather than go long it. Right. But if we think about AI, it seems inevitable that the powers that be want this to happen. Forget about whether I agree that we should be doing this or not. So if I make that assumption that by hook or crook, this is going to be part of our life going forward, how do we take advantage of it? Well, one, and what the typical value guys people hear all the time is this shit sucks up a lot of energy, right? A lot of energy. So is there any place we could look where AI has not been impacted the underlying equities? Now, today's a bad day, but we've been card carrying uranium bulls for 4 years, right? And we loved it just because of the supply demand dynamics associated with uranium. Forget about AI. AI is just the cherry on the icing on the cake. And we just think uranium is going to take significantly more market share as a percentage of power consumption, combined with the fact that it seems to be the preferred source of energy for all things AI. The other thing we're doing, which is really more part of our process, right? Which is, holy cow. And we just did it today. I can do a thoroughly analytical review of a single stock name using Gemini deep research and have an answer within 10, 15 minutes that probably would have taken us at the very least 2 to 5 hours. So, and this is free of charge relative to, say, subscribing to FactSet or Bloomberg or some other premium data subscription service. So it just seems to me you've lowered our cost of analysis by leaps and bounds as you guys are spending all this CapEx money to get us all to use it. So why not take advantage of that?
Go
ahead, Parker.
We've liked to fight bubbles, and I think the fun thing is to fight bubbles, but it can be dangerous, right? So, we've thought of this as AI for dummies. What's the easier play? I don't feel like chasing NVIDIA at some crazy multiple or, the Mag 7 at these crazy multiples. The one thing we did do well was we bought the value name in the group, which at the time was Google. And, the thought process was that, if you think AI was a bust, Google's core business is the cash cow in the group, right? And your search business would go on and they would still make a ton of money. And if you look now, they're number one, the Gemini is number one in the App Store, and they have the entire ecosystem. They've seen every query that you've ever typed into Google.
Right.
Where do I get beer late night? Like they have you down, right? And so
But we're attacking all of Kevin's isms on his podcast, just nailing them one by one by one. Is perfect.
Where do you get beer late?
Yeah. And then you have to think about NVIDIA is a hard one, I think, in that it's the hardware in the software space, and obviously they have a huge lead in chips. But the question is, I guess, is will they keep that lead? And they have 72% gross margins. You got to ask yourself, are the big hyperscalers and all the big Chinese players going to allow NVIDIA this lead, right? And this profit for an extended period of time? My guess would be no, but am I going to really go hard against that? Probably not. So
one of the things I find interesting about you guys is you take a very macro view of the world. You talk almost like macro, analysts, and then you go and do individual stock names or sectors. Is this a conscious choice, or is it, you found as an individual stock analyst that you were getting run over by the macro, so you figured you should learn it? Which came first?
Well, our core expertise is in financial services, right? And if you cover the financial services sector, so think Goldman Sachs, Bank of America, and just go down the market cap. Macro is part of what you had to do. You had to have a perspective on rates. However, we use it as a guide, right? As we search for micro ideas, right? And the other thing I would say is, again, you guys wax poetic about it. We do as well. I think market structure is dictating so much of what we see this day and age. And I think there were three massive forces in the markets today, right? Let's call it the Mike Green, right? Which is ETF passive flows, right? And just, young kids and their W-2s are going to target date funds and they're buying 30 names, right? And then you have the crazy vol targeting regime, right? Yeah. Which are the Citadels, Millenniums, the 0.72s, the Janes, and the quants, right? Which their degree of leverage is predicated on where volatility levels are. And not only that, given the sheer size of them and some of the books that sit in there, nobody plays in market caps below, say, 5 billion. So what we like to do, generally speaking, is two things. One, as a result of that, I think the market is incredibly inefficient below a certain market cap. And above that, so much is dominated by liquidity and flows right now than ever before. We like to play and troll around in what we like to call the land of misfit toys, right? Where the normal rules of engagement that we know as middle-aged Gen Xers still exist. The rules have not really changed all that much. We're still subject to the laws of gravity. And because no one can play in them, the pool is deep and wide. It's just no one's looking. So we dig through what we think should not be in that pool and purchase it. And we give ourselves some duration, call it 6 to 9 months, a year, sometimes 2 years. And what we're looking for is on a per stock basis, outsized returns.
Oh, that is so good. So is it 5 billion? Is that your cutoff? You think that's around there?
I threw that number out there. I actually think it's a little bit higher now. So whenever you speak to your pod monkey friends and you're talking about a certain name, the first thing they'll say is, "Oh, I can't look at that. That's too illiquid," right? And so
and all that means they can't sell $20 million of it in one day.
Yeah, that's right. Now, we have spoken before briefly on the phone, and when we were discussing, I think we did get into this discussion about pod shops and how much they've changed the environment. So let's go back there and let's talk about this, because I believe that the world has changed a lot, and that the structure of our market and the way that things trade and how it's behaving. And I think even the golds today and this past couple of months is a perfect example of the pod shops. I think the reality was that the numbers started going up. It started to hit on the quants, and then they were able to buy it again. And they're all driven by this. But I would love to kind of get your perspective of how they've changed the market, and is this a risk going forward?
We we don't like to admit it, but we did spend about 18 months at a very, very large market neutral fund. And it really changed our perception or our outlook on the market. And just by, we were old school, sort of Tiger-esque trained, right? Where you buy good companies and short bad companies. And we lived in that world for a long time. And then we went to, one of these pod shops, and yes, they do research, but it's managing tickers on massive amounts of leverage. And, they just think of the world totally differently. And they would have these rules, like you can only own a stock for, like they would, what would they call it, Vinny? Like youth or there
was an aging analysis.
Aging. Yeah. And so like they said, this position's old. I go, I don't care if it's old. I like the stock. It's great. It's cheap. It's going up. Like, but they want velocity. They want movement. They want you to hit every earnings print. And a lot of times Vinny would say, like, I don't want to play on earnings. Like, this is too volatile. It's 50-50. I have no idea, but they want you, fully invested on every single quarter. And so that's why you see a lot of that volatility. And for us, it might've been, we walked in there and we hated it the first day we walked in, and we said, we got to get out of here. This is a nightmare. And so, but we learned a lot, and actually I think we applied it to how we invest going forward. And that was helpful.
Do you guys think that it's a risk to the market? Like, do you worry about the proliferation of pod shops?
I think it dictates the market in part. So,
okay, explain that.
Let me explain. Let's think about Liberation Day, right? Why did post-Liberation Day act so poorly, aside from the fact that we were all frightened to death about those tariff rates that were put out? It's my assumption that at that time, all of the pod shops were all in because volatility was low, so their books were entirely grossed up, right?
Okay.
And now that you introduced an element of volatility and risk, they all had to do an ants marching and degross at the same time.
Right.
So if just more and more,
just the tail of the tape on that one, Vin. VIX, just the tail of the tape on that one. In March, the VIX was 15. Okay. It went to 60 in 3 weeks.
So now let's think about Fed policy when it comes to this. And if you let's subscribe to the Luke Groman and say that the S&P is a matter of national security, and I do believe that. If all of a sudden more and more of the capital resides in vol targeting, and if you look at it on a gross basis, and we could talk about why we feel this way, on a gross basis, meaning the gross notional capital that they're managing, right, is the incremental trading flow is dictated by these people, then all of a sudden, part of Fed policy, which they will never admit to, is to target low volatility levels. Because in order for that model to work, volatility levels have to be low. If volatility levels are permanently plateaued, right, they got to degross. And so we saw that during Liberation Day. But then, like, I agree with you, Kevin. I think what happened is once their vol metrics probably said, hey, you can go risk on again, this is the reason why we saw what we just saw. Right. So I think it dictates Fed policy in a large way.
And what were you were mentioning the gross levels. You think the gross levels are even higher than the market understands?
Yes.
Well, just look at it in terms of vol. When vol was 15 in March, right? They could probably lever, these quant funds could probably lever 6 or 7 times. But vol goes to 60 in 3 weeks' time. They have to degross, right? So they're selling and they're buying and they're just compressing, the book as quickly as they can. And so that's the reason, the market went down so quickly. And so it's the tail wagging the dog. Yes, the Liberation Day was a lot of uncertainty around that, but the vol increase alone was the reason for the market just to throw up on itself.
Kevin,
sorry, go ahead.
Could I get wonky just for a little bit?
Yeah, for sure.
To show our financial chops, right? So almost everything that we see in financials is dictated by regulatory risk weights. That's a long-winded way. And so post Dodd-Frank, because of the GFC, Dodd-Frank increased, generally speaking, the risk weights of all the financial institutions. You used to be a prop trader. You're no longer allowed to be a prop trader, those things. But most of the risk weights that were raised were on all things loans, then credit card loans,
mortgages,
commercial real estate loans, and like all things that touch Main Street, right? What was not raised, in fact, it has just been loosened, is all things securities and derivatives, because they get the ability to net and they add more and more things to the net to show that we don't have risk, and that it becomes then a function of volatility. So it's not surprising to us that all the froth and the bubble that you see is all things in. So this kind of fits into this whole K-shaped economy we see. I'm not saying it's the complete thing that dictates it, but it fits that all things intangible in paper. No one should have any business being able to YOLO basis trade treasuries at a 50 to 101 leverage. Nobody should be able to do that. No one should be able to play in the futures market and get umpteen amounts of leverage to express a position. They shouldn't, but they do. And as a result, that's why you see so much frothiness in trading and markets.
Okay.
and go back to the GFC, you can see why we're so scared shit of leverage, because we saw it firsthand.
Yes.
Right. And the danger that it produces. And so, and the quant shops know that. And when vol goes up, they shrink their books as quick as they possibly can.
Oh, speaking of the GFC, and I think you're the perfect guys to ask. Could you really explain to me shadow banking in a way that is accessible? Like, you hear some people talk about it, and I don't really get it as well as I should. So could you explain like the shadow banking, how it works, and where that leverage got put into the system?
Pre-GFC or post-GFC?
Let's do both if I could, and where it might be now.
Well, based upon what I just said, I think where it is now resides in securities and capital markets. I think the majority
that's not really shadow though, isn't it? Because isn't that reported?
But before it was on the bank's balance sheet. Right?
Okay.
That's no shadow about that. You can see it on Bank America's supplement. They give you exactly where the loans are going. They tell you, we're giving this XYZ to commercial and industrial loans, this to credit cards. And now the biggest sector that they loan to by a leaps and bounds is financial institutions. So, so they're allowing Apollo, Ares, and all these debt funds, private debt funds, they're supplying those guys with the leverage. And
not only them, Porter.
It's everybody.
The Citadels, the Millenniums, the Jane Streets, the .72s, they are all getting usually collateral-based financing, right, to maximize their leverage. I don't know exactly how they do it, but clearly the amount of dollars they're trading is significantly higher than their NAV. This is where I think the shadow banking system lies right now. And as a result, and it's usually what to me shadow banking is, you're not regulated by the OCC, the FDIC, or the Federal Reserve, or not directly, right? And and they're using the banks as a warehouse line, so to speak, or the central hub, as well as things such as the CME, which provides the margin requirements for everyone that wants to play. This is where the shadow banking lurks. I would say, and the major difference between pre-GFC and post-GFC is that I don't think the policymakers and the powers that be really understood where the leverage was. I actually think they understand it now. And my concern is that they're not going to allow any material adverse price discovery anymore. So like we view that we were probably the last people that benefited from material adverse price discovery. Home prices came down, everything came cascading down. It all sucked, right? But post that, I think they said, no mas, not on our watch, never again.
which is why everything gets inflated, and that's why you've switched to the other side.
Correct. Which if you take it even further, now you got me all going, Kevin. I actually think this is the biggest reason why we have a bifurcation of wealth between the haves and the have-nots. Because when it comes time for the people to lose, they cry to DC and they get bailed out. And you imagine if you keep doing that again and again and again and again, behaviors start to mount. It's only natural.
You know, the Silicon Valley depositors should have gotten wiped out, but of course they didn't.
Yeah.
Right?
And the irony of the all-in guys previously, talking all libertarian, and then the moment their bank gets into trouble, it's like, bail me out, bail me out, bail me out. It's just like, bunch of douchebags. I think
Kevin, do you realize, and I had this conversation with someone at the House Treasury Subcommittee or whatever it is, and a few others, that if the jumbo non-interest bearing depositors weren't bailed out, you probably would not have stablecoins, because the excess capital that was sitting at this company Circle, right?
Yeah.
Excess cash resided at Silicon Valley Bank. And it was in the form of non-interest bearing jumbo deposits that would have been an unsecured creditor. And so they would have, quote, broke the buck on USDC.
Interesting. Yeah, and then that's back to your point, Vinny, that in essence, by bailing them out, they're propagating this financial asset bubble.
Yeah.
Correct.
Yeah.
They're not allowed to fail.
Right. And going, my next question was,
you're bringing up old anger that we have here. This is
The good news, Kevin, is you asked a question before of why you guys look at the micro instead of the macro.
Yeah.
Because our macro heads are all fucked up with this stuff, right? And if we express it, you would be bearish all the time.
That's right.
What we figured out is, well, park your heads in the micro where it's not that crazy. There are some interesting things, and just express your macro in the form of gold. And then you're good to go.
That's the funniest part. That one of the things that liberated us was we the most bullish thing we were on is we were bullish on deficits. Right. So we were long, like, why don't we be long gold and all this other stuff that's going to reflate?
Well, that's a great line. I love it. Bullish on deficits. One last thing before we get off this shadow banking. One of the things that I've thought about in terms of crypto is that I stop and I think about the US dollar system in the late 1800s when specific banks could create credit. And we had this situation where they were individually creating credit. And there was like something like 10,000 banks or 20,000 banks, some obscene amount kind of going into the 1929, depression. And then it collapsed in on itself and all these banks couldn't do it. One of the things that worries me about crypto is that what if there's a huge amount of credit being created in there? And aren't we exposing ourselves? And doesn't that become an actual a risk to our society and to our economy as it grows? And it ends up being more difficult because, let's go back to the GFC. They broke the buck, but they were able to come in there and actually back all of the money market funds and put it back to a buck. But what are you going to do if there's a run on the crypto, on the stable coins?
I mean, I think if we start giving our views on crypto, people are going to turn the podcast off.
No. You can go ahead. Listen, they already know how much I like it. We're all having fun staying poor. So just go ahead. Do you agree that there might be more credit in there and it's something that is underappreciated?
Yeah, all it is this week I saw one of these, what are they called? Treasury DAX. Digital DAX, whatever. And this company, their DAC, their asset is Solana. And I had the president give me the pitch, and it frightened the shit out of me because his pitch was, well, we're trading at a discount to MicroStrategies. We should trade at a premium to MicroStrategies. And once we get there, we could just issue capital and buy more Solana. That's your pitch. That's your pitch. There's no other. And
then didn't you ask him what the use case of Solana was?
Yeah. And he was giving me some smart contracts. I go, you use these words, smart contracts. I go, those are if-then algos. Right? That's all it is. And I go, all you guys I see in crypto is secured margin lending. Now, I will say we've been studying the Genius Act and stablecoins, and I have to tell you, the man, you got to give a golf clap to how clever these people can be from time to time, right? Which is, they effectively have tied Bitcoin and Ethereum into the potentially too big to fail argument. Hold on one second. I think I'm being disturbed. Yes, you going on your walk? I'm doing a podcast right now. It's okay.
It's very on brand. Don't worry about it. Perfect.
So that's perfect. So, and if you walk through the mechanics of it, like now we're tied, and the buying and selling of treasuries de facto is tied to the level of Bitcoin, Ethereum, or whatever qualified asset makes it that is backing stablecoin. That's pretty frightening when you think about it.
Yeah. I think it's crazy. Okay, let's talk about something other. Maybe we'll step back. Why don't we talk about names you like? You obviously love the gold names. You mentioned a couple. What are some other ideas that maybe aren't as appreciated, that are, something that is truly a value name where you're picking up that you're willing to talk about?
Good questions. We're value guys, so we don't like paying a lot for the muffler, and that's hard in this market where obviously the valuations are, if they're not at all-time highs, they're close to being at all-time highs in terms of the valuation. So we try to step back, and I think I'll give an example, and I'm not recommending people buy these here, but early in the year we went on CNBC and we were pitching that we were long Chinese stocks, and at the time, Baidu was trading for about cash value. At the time, Baba was trading at 5 times earnings, and everyone was like, "Well, what's the catalyst?" Well, they're don't you know that you don't really own a security that the Chinese can take it away in any moment? And
China is uninvestable. Remember that one?
Uninvestable.
Yeah.
And so, the things, a friend of ours, James Aiken, he always tells us to ask the question, what can go right? And so you had all this negative Chinese rhetoric going on for so long, and Jack Ma, they obviously put him in a closet and said you're not allowed to earn money, and we didn't see Jack Ma for 5 years, and that was the risk to Chinese stocks, that came out, and one day your CEO was dead, and the stock was down 90%. So, but 5 years later, the rhetoric from the Chinese regulators starts turning, because they want to get the engine of the consumer economy going. And so you put breadcrumbs out there. You start with a cheap stock, or maybe you start with the premise that, hey, the inflection in the regulatory rhetoric coming from China is changing, and then you go look for cheap stocks. And so that's kind of what we do, and that's the process that we look for. I mean, Copy actually says it well. He does inflection investing, and we kind of do it too. Whether maybe we spend a lot of time on inflection and cash flows, or if you look at a lot of commodity names, you look at maybe an inflection in the price of the commodity, because obviously it's just price times volume. And so, so we spend a lot of time thinking, hey, what can go right? One of the sectors that we've been thinking about, and people have talked about it for a long time right now, and it's quote unquote dead, is oil and gas stocks. And we haven't been buying them yet, but we've been starting to figure out, hey, what can go right here? And if you look at, oil to gold ratio, or, even an inflation adjusted, oil is super, super cheap. And so, that's the type of scenario of like, hey, what's hated right now? What's really bombed out? Might not work today, tomorrow, but in 3 months' time, people are like, shit, this is pretty cheap. Things are getting better. And so that's kind of how we think about things. And if you put together a portfolio of, 5, 6, 7 themes like that, of, we were looking at copper. So, a year or two ago, and we extracted a couple copper names out of there. Same thing with the platinum and palladium names. We did the same thing. And so, as you see these reflation trades that go on, like gold was the first one to pop, and then the silver miners went, and then the platinum miners went. And so, we try to go through there. And so it's not all commodity related names. We have a lot of one-off, special sits, that value traps that we love, but at worst, we're going to get out flat or just eat it for the next 2 years. But if good things go right, we can make 3-4 times our money. That's how we look at it.
Got it.
The stock that I've had the most fun owning, I'm not sure, but it gets to our process, right? Was we started looking at, we love, again, shopping in Filene's basement and where things are bombed out. And one of the areas that was bombed out was the XRT, right? And so, and then all of a sudden, I think it was early August, late July, this company, American Eagle, decides to hire Sydney Sweeney as their brand spokesperson, right? And we're not dirty old men, but Jesus Christ, that seems like a good idea. Buy the stock, right? So we bought the stock, and it was like, we did the Druckenmiller. I think it's Druckenmiller or buy first, ask questions later, and do work.
I think is it Soros? Is it
might be Soros. It's one of them, right? And so like, and then all of a sudden we're like, all right, get over that, you dirty old men, start doing work. And then we realized, like, holy shit, this is trading at like 4 to 5 times EV to EBITDA. The balance sheet's clean. They just bought 8% of the float because they just took an inventory write down. And this is near and dear to our hearts because we've been on the wrong side of this frickin' trade for God knows how long. There's 18% short interest. So there's an ability to squeeze. And we just simply said, using the James Aiken, like, what can go right here? Well, if this woman somehow increases same-store sales from negative to flat to positive, given where the stock was, and it was 60 to 70% off its high, this thing could pop like mad. And so that's the type of stuff that we like to do. Whereas we go in, we try to find names that has this coiled spring energy, but we clearly know something has to inflect in the fundamentals. If it doesn't, then we're just going to sit on something that just sits there. And that's kind of the way we like to play the game, and also look for themes in the process.
But we used to pitch this name, and people they'd laugh at us for about a month and a half. You'd be like, dirty old men, what the fuck are you doing? and stock went from 12 to 20 where it is today. The problem Vin and I are going to have is that we've owned it now for 3 months. We got to own it either for another 9 months or wait till long-term capital gains or figure out what we're going to do with it. But that's champagne problems, I guess.
That is more champagne problems. Okay. You guys are old hands at doing these podcasts, and you've done some interviews yourself. What would you have asked yourself that I might have missed? Like, what is something that I should have been asking you about that's important about about you or the environment that we're in?
I got one. We were talking about it today, Porter. When do you get off this faux train? Right? Like, so,
yeah,
for a bunch of cynics and bears, we've been running that long, right? And it has served us well. But we all know this game has to end at some point, right? And like while we're playing micro bulls, our macro is like crushing us down, and we're like, how do we get off? When do you know you get off? And that's sadly I don't have the answer. So thankfully you didn't ask. But it's the question we keep asking ourselves,
right? Because
we know at some point this is probably going to end, and we probably don't want the exposures we have when it does.
And by that you mean you've been playing this reflation, and that's your grand kind of bigger theme, but within that there's still going to be cyclical business cycles. Or do you mean that it's actually the whole macro cycle is going to change?
Well, obviously it's been a bull market for a long time, right?
Right.
And the question is when is the bull market over? And thankfully we've fake dressed up as bulls recently. I would say for the past 5-6 years, and it's been the right call. The question is when is the right time to get off? what are those conditions that's going to wave the white flag and say, Vinny, it's time to sell? And I think that, we actually, we shouldn't say we've been bulls for, we were very bearish in 2022.
Okay.
Or in the later half of 21, when, these value, you look at the micro cap index, it's finally breaking out again, but it's nowhere close to where it was in post-COVID. Right. And
Right.
so, we saw the inflation just like a lot of people did. And we're like, fuck, this is going to be a real problem. And, the thing that concerns me now is that, we're cutting rates, but we're nowhere close to the 2% target. And I think gold's kind of telling you that today, that you guys are cutting rates again, and you're nowhere near the 2% target. You got Fed's Trump's guy calling for 6 more cuts, and he's only the first Trump governor in. He's getting like 3 more soon. And so are they going to run this thing so hot where inflation takes off, and that's going to kill the market?
Yeah.
And there are so many excesses all over the place, and there's growing social unrest. You can feel it, right? You can feel the tension between the we talk about politics all the time. I've pulled back so much from political views in the past, call it 10 years, because it's not helpful. It's really not helpful for investing, because everybody's so charged up. You're either Trump deranged syndrome person or you're a MAGA person.
Yeah.
And for us, it's not helpful in investing. So, there's that tension everywhere. And I think that, the next bear market's going to be probably pretty bad. And we think almost every day about what are those conditions going to make us sell everything and go to cash and watch the prices right at 11 o'clock and enjoy our day.
So you have no insights though in terms of what they are. It's just that you're looking for them. Were you looking for them 3 months ago, or is this a function of the new price? Like, has it changed? Has your attitude?
We're always looking for. You have to always.
We're bears. We're always looking for them, right?
Okay.
But we know now that they've increased stimulus into the system, I think we're back into a liquidity-driven market. And so what will cut this off is a forced reduction of liquidity, like we had in 2021 when Powell came in. And what will cause that is inflation that will be politically untenable. Okay. And so as a result, that's what we think, subject to change, we're going to get it hot first. And then as the economy percolates and inflation rears its ugly head back into statistics that people actually will consider inflation, don't get me started there, then all of a sudden we're going to get probably really bearish.
We're so heavily indebted. This is a refinance market, right? And so there's so much, there's treasuries, whether it's anywhere, there's all this debt, and it's a refinancing market all the time. And so and this goes back to our financial services background. When the Fed pulls the punch bowl, or the financial conditions tighten sufficiently, that's when the problems arise, right? That's when Blackstone can't sell, portfolio 721, right? They can't liquidate it, right? And so when those financial conditions tighten, we're going to see it, and we're going to get bearish.
Do you think that private equity and private credit are a disaster waiting to happen? Are you as worried about that as some of the commentaries that you hear?
Well, they've done a good job of hiding it, right? They've suspended mark-to-market accounting for 4 years, right? They've done a beautiful job of that, right? They're just, all these big universities aren't getting their distributions, right? They just been, you're flat again this month. And so, when you don't have price discovery, lo and behold, it's not a problem.
Yeah. A quick question in terms of the economy. Do you think that you mentioned you think they're going to run it hot? Do you think that it is the labor market is giving false signals of weakness?
No, I actually think the labor market is weak, weaker than it has been, but it's really hard to get incredibly weak when you're running 7% fiscal deficits. But
Right.
in order to get the economy percolating again, I think they're, and this is something we did not speak about, they are hell-bent at getting rates low and getting the housing market going, because that's a needle that can move the economy. And that's why I'm not surprised that Treasury Secretary Bessent and Trump has declared housing a national emergency, right? What does that mean? Or more importantly, what are they going to do about it? And rather than get all nervous about it, just think about what crazy cockamamie thing they're going to come up with, right? To try and get the housing market going.
What do you think would happen if Trump, well, let's not even talk about him firing Powell. Let's just imagine he puts in, Zervos as Fed chair come, the summer. And Zervos ahead of time says, once I get there, my goal is to get rates down to 2%. So he, in essence, guides the market, even though Powell's still in charge, and potentially could actually, move the forward curve down, right? What do you think happens in that environment in terms of the economy, the stock market, and does that just cause the dollar to go no bid? I would love your kind of opinion about how that plays out if a true Trump kind of yes boy gets put in there.
Well, you're talking about your yield curve control, right? And I mean, the Japanese are the leading edge of yield curve control players, and they pinned yields at basically zero for a long time. And now yields are, they're not that high. They're, 1.6, right? The Japanese 10-year. But, they're talking about raising rates. They're talking about selling down. They're selling down their all the ETFs they bought over the next 100 years. And, so I think the yield curve control is inevitable. I think quantitative easing is inevitable at this point, right? There's just too much debt, right? And they need buyers. That's why this whole stablecoin stuff is to find buyers of our debt. And, we're rolling down the curve. And so, again, you can either be bullish or bearish on that. You can take our bearish hats and say this is a fucking disaster, or you can take the bullish hat of saying I'm bullish on deficits, I'm bullish on reflation, I'm bullish on inflation, and play it that way. And so we have sort of many minds about that.
And that's going back to your Vinny's point about when do you leave? Like, when does that tip from the reflation to the kind of bigger problem and a crisis that causes the stock market to sell off?
Well, if yields go above 5%, like, you can turn off the lights here, right? And so that's why it's of national security, to get rates down. It really is that existential, because we're running 10% budget or 8% budget deficits now. Imagine what happens in the downturn, right? And so that's what drives me nuts. That the recklessness of these politicians and of the central bankers, and they're in it together, and they've aided and abetted each other along the whole process. Vinny yelled at Bernanke about this 10 years ago.
Okay, wait. There's a story. Okay, this is what we'll end it on. This. When did you yell at Bernanke?
So Bernanke consults very large multi-manager hedge funds, it's known. And when we were in one of these places, he was actually consulting. And he usually does it like a week or two before the Fed opines. And he wasn't with the Fed at that time, so there was I guess this was all legal. And so for whatever reason, they sat me right next to Bernanke.
Vinny took a page out of Steve Eisman's playbook, and he's so juiced up.
I was literally grinding my teeth, and I go, you got one shot at this, kid. Let it fly, right? And so I essentially asked him a question of, one can argue and put myself in this camp that you and your institution, your former institution, the Federal Reserve, have aided and abetted all of the excesses that we see in fiscal spending by printing money and allowing our government to issue debt at an extremely low price, artificially low price, I might add, right? And it's actually you guys that have enabled all of this. What do you say about that? And do you take any, responsibility for what we're seeing right now? And he basically went, meeting's over.
And he walked out.
First he said, that's rubbish. And then he said, meeting's over.
Oh, that's pretty small of him, because listen, you're correct. Like, the reality is that if they had risen rates, and the government might have behaved differently. And actually, that's one of my biggest complaints about the Fed, is that when they went to raise rates, they in 2022, they didn't sell off their balance sheet. They should have been doing quantitative tightening immediately and pushing it back out into the market and forcing the market to discover what the correct price of that was.
Yeah. But as we said, there's no price discovery anymore that's allowable.
Yeah. Okay. That's a great story to end it on, but we're not going to let you go off without getting your desert island trader picks. Okay. And so for those who don't know this game, it's there's a BBC show called Desert Island, and you get to pick 10 albums or 10 bands that you want to be stuck on the island to listen to. So we do the trader edition, which is you get 3 albums or 3 bands, and then one trader from history that you get to be with that will help you trade during this period. So who wants to go first?
You go first, Porter? I'm dying to hear your musical things. I don't even know where you're going to go.
My best friend's a huge piano player, and so I'm very partial to that. And I could either pick Billy Joel or Elton John, but I'm going with Billy Joel, and that's my first one, Long Island Zone. And then I'm obviously a huge Zeppelin fan. And my last one, I'm wearing actually the T-shirt right now. Bob Marley, love Bob Marley.
Oh, there we go, a little bit of Bob. Okay, and what's your trader?
Because we got our start in the hedge fund business as being sort of Tiger-esque, or I pretended that I wanted to be a Tiger-esque investor. My pick is Julian.
Oh, that's a great pick, Julian Robertson. All right. Vinny?
And he's created quite a stable of unbelievable investors, and a legacy that along the way. So
that's right. Okay, Vinny, what do you got?
So Zeppelin, that's the boring one. I can imagine for people our age, it's going to be so common. I was debating between these two guys, but I'm going with Prince over Michael Jackson. I think he's probably arguably the best musician of our lifetime, pound for pound. And
he only weighs 90 pounds though, but so.
Yes, it did. Yeah. And then I'm a big lover of old school hip hop. So I was debating between Public Enemy to get my rage out or Dr. Dre, but I'm going to choose Dre because you get all of NWA with that. And and 50 Cent and Eminem, you get them all because of his production.
Got it. And who's your trader?
And I'm not kissing ass to him, but he is our mentor. But with him, we get all of us just for pure entertainment factors. I would choose Eisman because our time at Front Point, right, was just so magical that it was pure entertainment every day, right? It was almost like being on a Curb Your Enthusiasm episode every day. And it's just the banter of all of us having fun, which is, I would love to bring back the crazy that we were dealing with during that time frame.
When LinkedIn first came out, I created a LinkedIn account. This is called 2009 or whatever. And I put job title, I put zookeeper. And I can't find that password, so it's still out there. Porter Collins zookeeper. So it was a total jungle between bears and bulls. Lots of interesting personalities. We had a lot of other people on the team as well. So it was an amazing place to work.
Oh, that's great. Those are great picks. Okay, so before we go, you guys have a new venture. So let's take some time to plug this and get you some people listening, subscribing and listening to your new podcast. And let's someone give us the plug.
So on top of just managing our own capital, rather than open it up to outside investors, which we didn't want to deal with the headaches and the agita, we said, well, why don't we write sort of a blog or provide commentary, sort of a blog of what we do on a daily basis. You know, we're already in the social media, crowd. Let's have some fun, right? Doing what we're doing. And pretty much what we're doing is we think we're a little different in that we're sort of single stock or thematic contrarian players. So we started writing a Substack called What Are We Doing? As well as providing a weekly Friday podcast, right, called the Friday Night Dirty, with our partner and also former Big Short alum and From Point alum and Seawolf alum partner Danny Moses, who's in the podcast world. And it's just, again, coming back to my choice of Eisman, it's just really getting the band back together and having fun, but doing it in a way that we think is quite educational.
All right. So it's What Are We Doing? And is when you subscribe to What Are We Doing, do you get the podcast or is the podcast separate?
No, that comes with it. The Friday Night Dirty comes with the What Are We Doing? Because it came from, we'd be on the desk and we'd walk in the morning and be like, what are we doing here? Like, why are we even in this position? Like, what do we do? Just sell it, so.
And the other thing we've enjoyed, because we've been off the institutional reservation for quite some time. So we're really more retail investors or high net worth managers. So we had to scrounge around and find alternative sources of information. That's kind of how we found you guys, Kevin, and everything else via Twitter and the like. And then we started playing around in Discord chats, and we just found the community, this odd ducks of professionals, extremely value added to our process. So what we want to do is sort of develop a community of people who are like-minded or even not like-minded, to be honest, to join us in this fun that we're having of playing idiosyncratic names and building a portfolio of weird stocks that hopefully can outperform the S&P.
Okay, sounds great. So it's What Are We Doing? It's WAWD. I'm just looking at it right now. It's on Substack. You get your writing and the Friday Dirty. Is it?
Friday
what is
Night
it again?
Dirty, yeah.
Friday Night Dirty. So you guys going to record this right after this?
We did it this morning, but
you did it. It's Friday morning dirty to this week.
Usually, if you want to announce bad news, you always do it, Friday at 8:30. So no one actually sees the news, and then by the time Monday comes around, they forget.
By the way, we just got one.
Really?
Right? France just was downgraded their debt rating. So that is the perfect definition of a Friday Night Dirty.
There we go.
You don't do it on a Wednesday morning. You do it on Friday afternoon.
That is awesome. You guys, it's been a real pleasure chatting with you. Thanks so much for taking time.
Thank you.
Thanks for having us.
All right, Patrick, it's time for Talking Charts. What do you got for us?
Well, listen, what a week. We had the much anticipated FOMC. And I'd love to just get your take on what you took away from it. But obviously, they came in and made it pretty firm now that they are going to be doing the 3 cuts this year, right? There's 2 more coming. But I think the market was expecting a more dovish sounding Powell. And I think that they came across very kind of like growth is still high and inflation expectations are still a little bit higher, like that they may not do many more cuts after that. Like, what was your takeaway?
Yeah, I was actually surprised the stock market took it so dovishly. And looking at the reaction from the bond market and the currency market, I think they correctly interpreted it as a very down the road, middle of the road Powell conference. And in fact, if anything, I think it was disappointing relative to the expectations that you highlighted there in terms of their expectations about forward rates. And I'm just looking, like you mentioned, the fact that they firmed up the fact that there's going to be 3 more or 2 more hikes now until the end of the year. And I'm looking at the end of the year, like in the WRP function on the Bloomberg, I'm looking at like what they expect end of the year FOMC rates to be, and it's unchanged. It barely moved. Like it's just a straight line. So I'm with you. I'm a little confused why the stock market was so bullish. And to me, it indicates the fact that the stock market is not trading on Fed expectations, and that's not what's driving the stock market. and that the currency market and the bond market correctly got it, that there was down the road, if anything, a little bit hawkish versus expectations.
So the interesting part of what you just said, I agree with, is that, but there also could be just simply the lag time. Often currency and bond markets are the first to react, but we've seen scenarios where bond markets and currency markets will move for an entire month before suddenly the stock market has this kind of aha moment. It's like, oh wow, things are out of caliber, and suddenly the stock market joins the party on a lagging basis. And so we could have a scenario that if the trends did legitimately pivot in the bond markets and in the currency, that the stock market will start to care at some point here.
Yeah, no, I'm with you. So far, though, just the mania is the mania, right? Like, and we both talked about it, 2 weeks ago, that we thought that the stock market was getting a little bit tired, and it doesn't show any signs of that at all.
Well, it is rising in a tired pace, but it is rising, and then we'll talk about it in a second. So let's start off just quickly looking at the silver futures. So this is exactly what you were talking about, in one sense, that like this is the December 2025s, and the Fed basically gave the market exactly what they were pricing in. There was virtually no movement whatsoever. It's like if you even looked at this chart and said point to where there was a FOMC thing, you couldn't identify it. Like there was literally no movement on this. But what's interesting is that when you go to,
can I take a moment out to just kind of point out that you have become a complete stir trader? And for those who don't know what stir is, it's short-term interest rates.
Yeah,
you're starting off with December silver futures as like the most important chart to watch.
Well, no, listen.
I love it.
After the Fed meeting, that's a place to start, in my opinion. That's not going to be normal. It's just like I was just simply feeling that this was a good reinforcement of the statement you made.
It's okay. You can be a stir trader and be proud, buddy.
Don't. Okay. So what's interesting is that though the December 2026, which arguably more accurately reflects potentially where a terminal rate could land, started to fade. Like we were at the 3% level a month ago, started to price in potentially a rate lower than 3%, and it's back to 3%. And so clearly Powell talked down the dovishness in the market for now. There was obviously the reaction in the bond markets, but what I want to start with is the dollar and that turn. And what we basically saw was, without knowing what was going to come out of the Fed, the dollar basically traded right down to its July lows. But it wasn't just that it went for a direct double bottom retest of its lows, but the most important currency cross in the pairing, in the euro US dollar, actually broke to a higher high. And so guess what? The noble animal might have just shown up.
In the currency market.
Prairie dog.
Oh, yeah.
Is this a prairie dog? Like the euro broke out before the Fed meeting, and then even broke further north of 119 in the post reaction, and then it's been selling ever since. So to me, this is a very interesting. Whenever you have a breakout candle, listen, I'm going to give you some little technical analysis that I've observed from my years of experience. When you have a breakout candle, I always say one day never makes a new trend. It's the breakout day itself is not important. What is always most important is the next 48 hours that follow, which is essentially a scenario where do the bulls maintain the price? Do they follow through? Do they continue to show up? Is there more new flows coming in to build on this new trend? Or is it a fake out that completely fades and wipes out the entire breakout? And so the 2 days that follow are often way more important than the breakout day itself. And the fact that we had a breakout to a fresh 52-week high on the euro, and it completely faded the breakout candle, it is not a plus for the bulls. Let's just put it this way. It's not what they wanted to see. And then when you go clearly, there's some political things going on in with the budget there in England, but you basically have had a legitimate breakout attempt of at least for a multi-month high of the pound, and immediately fades. Right. And even, I know you spent a little bit of time out in London. I'm just going to look at, for instance, the 30-year bond, but you can see that without making a higher high, the 30-year bond out in the UK basically completely rolled over and broke down,
Is this
making
the yield you're looking at?
no, this is the bond.
This is the price. Oh, I see what you're saying.
This is the actual price, and
The,
so
the
you have
61 crew is not going to be very happy with that, man.
no, they are not. This is why that's why I brought it up, because you were kind of talking about that whole everyone loving that long bond there, and so we have a situation where we've seen, at least in the currency markets, a couple of major European ones fading, but the other big one was obviously the U.S. dollar against the yen. That 50-day moving average has been holding every pullback that the U.S. dollar has had for about all summer, all July, all of August. And we had a couple of closes going into the Fed below there, like there was going to be a fresh breakdown out of this trade range, and immediate reversal. I know that in Japan, they announced that they're going to start unwinding some of their ETF purchases and other things like this. I'd love to hear your take, but clearly the currency markets were anticipating, and I think, a much more dovish Powell. And the moment that press conference started, his tone disappointed whatever the currency markets were pricing in, and the U.S. dollar reflexively was snapped right back onto the upside. I would not want to call any of these bullish breakouts, but clearly the dollar reversed the moment the FOMC happened here.
Yeah, I can't disagree. I think it was definitely buy currencies on the rumor, sell on the news situation. And this is ultimately where I stood when people asked me what they thought about what my forecast was for this upcoming or this previous Fed meeting. Was I said it's going to be tough for Powell to, confirm the level of dovishness that the market is priced in. And yet, you've highlighted the fact that the U.S. dollar is correctly interpreted it, that the interest rate market is correctly interpreted it, and it just leaves stocks like all out on their own, like, interpreting it differently.
Absolutely. So let's look a little deeper on the bond market, just to reference, because we'll talk lots of stock market stuff here in a second. But I wanted to just simply highlight, when we go and look at the U.S., let's say 10-year, the bond did reverse. Like, so we had it finish a zigzagging measured move on the upside. And it was due for a correction. And this is the really interesting moment in the bond market, because it reversed. But just like the dollar, we have not seen legitimate technical price action that has reversed the trend that's in place. Arguably, the U.S. dollar still is in a distinct downtrend in spite of a couple of days of rebounding. And at the same time, these bonds are still in a primary uptrend. What's interesting here is that the 10-year note futures here basically are now at a 50% retracement of the last bull advance, at the same time as testing what were all previous highs, which often act as support, including that 50-day moving average right there. And so what this is going to be a real tell here, virtually at these price levels where we're trading, as to whether this was just a pause in a new bond bull market, or did things legitimately reverse and we're back to bond bearishness. This is not enough to put the nails in the coffin of this this bull thing, but we are really at an inflection point where if the bulls want to keep the party going on bonds, they're literally going to have to hold the line here. Now, this is the level where if bonds were going to go higher, they have to hold.
I feel dirty saying this, Patrick, but I think you're correct. And actually, I find myself short the least amount. Actually, I'm flat bonds, which for me is like, that's like
being
being
bullish.
long. Like that literally is a long position for me. I'm flat bonds. I even took off my break even trades that I've held for years and years. And I think it's one of these cases where um, a, 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 a Fed that is not as dovish as everyone expects is actually good in the long run for the long end of the bond market. And that's what I think people are missing. So yes, the knee-jerk reaction is to sell bonds on the fact that the Fed is not cutting as much as the market hoped. But over the long run, when you're thinking about it as a long bond investor, you don't want a Fed that's compromised. You don't want a Fed that is pushing rates down too low, because ultimately that's going to mean, according to theory, more inflation, and therefore more inflation erodes your value. So I think you saw a little bit of the steepener trade coming off. I think there was an article that PIMCO had that trade on in size and they took it off. I suspect that that for a while now, you're going to be able to trade bonds from the long side, which is really like very, very unusual for me to say. And, but I look at this and
Cuppy got it right. I mean, he's
well, we'll see yet. Like, yes, he's like, it's going the right way, but I don't think he's trading it for an extra 2 points or whatever. I think he's trading it for a bigger move. And I think that's really the question is the economy rolling over as much as the economic bears like me and Cuppy believe? Or is this the start of a new cycle as the Mike Wilsons and all the tons of Wall Street strategists believe? And I'm going to take the other side. Like, I think it's the end of the extended economic cycle that we saw that started in 2020 in post-COVID. And even if you wanted to argue that there was a cycle in 2022, which some people do, it still means that we're 3 years into a cycle. Yeah. So I think that really ultimately comes down to where you are in the economic cycle in terms of what you believe.
There you go. We'll definitely watch. We're definitely at the crossroad on those bonds, and we're gonna see whether the bulls can hold the line here at some very key buy on dip zones. That typically, if it's a bull market in bonds, these are the levels that should be bought. Like, this is where you would see them leaning into the dip buying, and so we'll see where that materializes. So let's talk about the stock market. And so here are the S&P futures. And the rising wedge has been relentless. It's we continue to see it just not quit on the upside as it continues to crawl higher on an intraday basis. There's a new hourly measured move that could theoretically measure all the way up to 6,800 on this advance. The market continues to make higher highs and higher lows. There is zero evidence that the bears have done anything to regain an edge. But what is interesting is we're speaking now on OPEX. This is the option expiration.
Right.
And often everything from gamma pinning to positioning dynamically changes over this weekend. And the question is with no real major news next week and a lot of this gamma kind of flows dissipating, the question is the market will be far freer to suddenly begin a trend move. And the question is, which direction will that trend be? Will it be a continued resumption of the bull to a higher level? Or will we see that once we get past that OPEX, that suddenly that long overdue market correction it comes in? And so, like Kev, what I wanted to specifically talk about was just the actual length of this rally without a 5% correction. So I went and did my own little quantitative analysis going. It's bizarre, but I sometimes do this. I like pull out a spreadsheet and do some like mathematics.
Don't lie, you didn't do it, buddy. You got someone to do it.
No, I did.
Really?
But what I want to highlight was that going back to the start of the decade, so back to January 2020, there have been 25 market corrections that were greater than 5%. Like just like the 5% variety, including the crashes, right?
Okay.
Like the COVID crash and everything. 25 of them. 14 of them were in the 5 to 10% range. So, 5.5%, 7%, whatever, like, your typical pullbacks, 14 of them, but 11 of them were greater than 10%, including 4 of them that were greater than 20% in terms of their drops. So the frequency of at least a 5% market correction is once a quarter. Like just doing some basic division of the frequency that has happened over the last almost 6 years.
Okay.
And so we have a scenario where this rally off of, now, first of all, in fairness, it should have been a strong rally, because the magnitude of the drop of Liberation Day, there's a reflexivity of it. And so the bigger the magnitude of the drop, the rallies are equally as big on the reflexive side. So here we are 164 days into almost a 36% stock market advance.
Okay.
This is the 100th percentile, where this is now the longest for this decade, and not beyond. So this is not a huge back test, but for this decade, this has been the longest and the largest in magnitude rally without a 5% correction.
Wow, that's interesting. I wouldn't have expected that.
Right, and so. And the second longest one was the 2023 going into 2024, where it was like 157 days and 30%. So we are now in a period where, and that in itself doesn't guarantee a market correction. No. But when you look at it from a context that market corrections are the natural part of a market cycle, and and this is not some sort of new paradigm where stock markets don't correct. You
sure about that?
Well, I'm not so sure anymore. But some sort of at least 5+% market correction would be natural to start at any point. And what will the trigger be is the puzzle to solve, isn't it? Right? Like, clearly the Fed wasn't it. There was a chance that the Fed could have been it, but it wasn't. And so what is the next kind of catalyst for doing that? Now, eventually we'll get it. Now, my speculation is that it won't be a crash this leg. Often I'm always on alert for it, but like the idea that the stock market is just going to start some sort of a decline is while the probability of it isn't zero, I would not suggest that that's the most likely outcome. More than likely, what happens during market toppings is that you have one of these 5 to 10% market corrections. Let's call it down to 6,200 or something like this. And then often the market will still yet again retest the highs. It's entirely possible here that when we do get this correction, that will still be bought on dip, and we will have some bigger topping formation start to develop through the fourth quarter of the year. Is at least my starting base case of how I think this market will play it out. The puzzle to solve is, do we still go to 6,800 before this correction even begins? Like, I don't want to keep talking like this is guaranteed to happen on Monday. Right now, the bulls remain completely in control of this market. And we have to give them the benefit of the doubt that they're still in control. But we're going to look for what are the trigger points for one of these corrections.
Great points. I'm with you. I think the OPEX is more important than folks realize. I as well was surprised the fact that we had a seasonally weak month. September didn't seem to work. We also had liquidity tightening up, didn't work. And now are the bears just basically grasping at straws? Having said that, unless you believe that the markets, have entered into some strange new paradigm where they don't behave like they have in the past and that they're just going to go straight up, it seems kind of foolish to be chasing here.
Who was the market guy that said, if it's obvious, it's obviously wrong.
Oh, that's Mark Fisher. He's the
Yeah, okay.
guy that trades crude oil, and that's one of his favorite lines. It's great when it's obvious. It's obviously wrong.
And so the thing that I've noticed with seasonality is the moment it's obvious that we're going into the weakest part of the stock market and everyone is positioning, expecting that this is when the stock market can turn. It's obvious the market isn't going to turn when everyone's expecting it.
Well, and if everyone's talking about it and position, and you highlight, so the seasonality will work in that it'll work because everyone will forget and go, oh, geez, that September never works. And so then nobody will position for it. So therefore it won't be a problem. It's always kind of like whenever someone's worried about a certain, crisis happening, it never occurs because the simple fact that they're worrying about it means that they've taken precautions for it. Yes. This is what I argue, in 2023 and 2024, when everyone was talking about the huge recession and all of this stuff. And I would say, like, constantly, I would remind them, like, the fact that you guys are worried about this is actually reason why you don't need to worry about it, because it's priced in. And contrast that to today, where it's in fact just the opposite. Yeah. Nobody seems to be worried at all. And I know that some people claim that everybody's bearish, but I don't know anybody that's truly bearish. Like, I watched Lloyd Blankfein talk about on CNBC, the former CEO of Goldman Sachs, talk about the worries that he has. And yes, he sounded bearish. He sounded like he was worried about all these things that many of the bears, highlight. And then they ask him, what's your position? He says, oh, I'm 100% long. and to me, that's what this market currently is. Everyone is, even if they're...
You can't. This is the hard part, is that you literally can't not have skin in the game on a bull market that hasn't yet turned, right?
Well, you can choose to not play and be,
but it's not. It's
very emotionally difficult.
It's difficult because then you continue to watch the market rising while you're sitting in cash.
Yeah,
and I've been like, there was this article that was showing the record amount of put selling that's going on. And I actively manage an account with just dedicated to put selling. And I probably have the least put exposure that I have had in over a year at this moment. Like, I'm sitting so conservatively positioned, and it feels like I'm not making any money while the market's going up. The emotional impulse to go out there and just say, fuck it, I'm just going to keep going, is so high, and just staying conservatively positioned is so hard.
Yeah. That's why extremes happen. And that's why there ends up being, when, extended more violent moves than should otherwise be the case. Yeah. And I saw Tom Lee. Someone was nice enough to pass me on Tom Lee's presentation the other day. And Tom Lee literally has this chart saying that this is the most hated rally in the world. And I'm like, are you high? Like, this is the most loved rally that I've ever seen. And like, I completely and utterly take the other side of that. And in fact, one of my big arguments is that everyone's, focused on the US, and the reality is that the rest of the world is outperforming on, many different, basis. So, like, if you go look, I wrote this piece where I looked at the year-to-date returns of the S&P 500 versus all the other different indexes. The S&P was at the bottom of the pile. Then you put it into US dollars, and it's even more at the bottom of the pile. Then you put it into a Sharpe ratio where you actually look at it, adjusted for, risk, and we get into a situation where it's dramatically worse than everyone else. So everyone's all excited about the fact that the S&P is rallying. Meanwhile, the MSCI World X US index is up, like, has a 3 times Sharpe as the S&P 500.
Yeah.
And so to me, this is the real story here, is that we're experiencing a global reflation. Everyone's focused on the US, but that's not really what's driving this. It's the spending out throughout the rest of the world. And they're actually outperforming everywhere else. And that, in fact, the U.S. is lagging in a lot of ways in terms of their stock market.
Recently, absolutely. Like, well, we can talk about that. Just take the most basic thing of just looking at the emerging markets, EEM, right? And not only has the emerging markets had a run up 30% like the rest of the stock market did during the kind of post-Liberation Day rally, but the last few weeks, just the last 2 weeks, we're up 9%.
Yeah.
Like this kind of reflation trade impulse that has happened on whether it's the Brazilian market, India turned back up. Like let's talk about these. Like look at the way here I'll just look at it on the Sensex, but like we had India correcting and suddenly it's back in the game. But look at the way Brazil has broken out to a higher high. But you look at the way for instance, Mexico continues to rip higher. Like you can go country after country in all of these. Like look at the way like the Kospi is ripping to the upside in South Korea. Like we have a market. We haven't even talked about China and the fact that China has broken out in a big way. Now, this is the China A50 and it looks like it's stalled out, but you could take something like the K-Web, which is the Chinese internet stocks. And just in the last month, they've ripped 25%.
Yeah. And Patrick, back to the bonds just very quickly. One of the worries that I have in terms of my concern about being less short is that what if we are experiencing a global reflation? And that is, I'm sitting around looking at the US labor market cracking and seeing some signs that the economy is slowing. But what if the rest of the world almost drags the US up? What if we get everyone else spending? And that is what I'm concerned about when I get too bearish on the economy in the US.
The question is it therefore the best thing to do is to be playing it more like a pair trading rather than an outright short on the S&P, which is essentially you have to be long reflation at the same time as you could be hedging. You'd have to get some sort of convexity into an S&P fade because you don't want to be taking delta one risk on the upside on it in this kind of scenario, but you almost play this idea where there's going to be relative outperformance in all the reflation trade assets over that of S&P for performance from here.
Yeah, and I just back to the bonds though. That's what I'm saying. You're trading them from the long side, and if let's just imagine the world economy accelerates from here, it's going to be tough for those bonds to keep going up. Yeah, right.
Well, look. Bonds ripping higher is 100% kind of a disinflationary economy stalls kind of narrative. And if that narrative is not materializing, you can't be long bonds. You can't. Right. It's that's 100%. We're in an environment where it's like no matter which way you cut it. Let's just look at the big picture of bonds, right? Like me and you have had this conversation a million times, but like when you go on a weekly chart and you look at the bear market of bonds for the last since the start of the decade, just because there could be a bullish reaction on bonds down here does not mean that the bear market is over. Yeah. Like just because you play a 6 month or 9 month bond market kind of a rebound thesis, which is something I've talked about numerous times as well, doesn't mean that you have to be big picture bullish bonds here. This is a very challenging time to be playing this bond market that way.
Yeah. By the way, when we were going back to the stock market and you were talking about this fact that you thought any dip would be shallow, right? Was that a fair assessment of your position?
The first leg would be shallow. Think of it like the scenario that I would like to describe is that we could see a scenario sort of the way that 2007 played out. Not that I think 2008 is coming, but 2007, we had that July market drop. That was about that 10% market drop. and then it still rallied back to its highs in October of 2007 before it really rolled over. And so often the first leg is bought on dip and still creates what is technically a topping formation, like a head and shoulders or double top or some other type of a typical distribution cycle along the market highs. And all I'm just highlighting is that I just don't want to put a high degree of probability that any market correction is a straight down one.
Yeah.
Right. Like,
listen, I hear you. That's the correct call. But I just the reason I bring it up and ask you that is because while you were talking about that, I was like, you know what? I remember a time when it kind of came out of nowhere and was a bit of a worse correction than everyone expected in September of 87. October 87. So I pulled up the charts and guess what? In August, guess what the S&P was up on the year?
I don't know.
37% going into August, or sorry, end of August. And then it dipped. And let me just I'll put in my thing and like,
because circuit breakers won't ever allow another one of these though.
No, I get it. I understand. It's interesting to see because I was like, oh, and by the way, saying that, you know, that you're goochering it. So then it had a dip. What was the dip here?
I've just goochered the trade.
Yeah.
The interesting part about okay, well, let's kind of work on this thesis, because what we basically had back in April was every systematic strategy had to be flat or short the market at the bottom.
Correct.
And you had the whole vol targeting fund thesis flows. By the way, do you have an update? Like, do you?
I got to go do that actually. Yeah, I got to go do that. We got to be getting close to the end.
Yeah. So as these vol targeting funds, CTAs, all of your gamma traders and like hedgers and all this stuff like that, they are now on the other spectrum. They've got to be somewhere close to being completely invested, like where the marginal further buying has to be incredibly marginal.
Oh yeah, I just pulled it up. Yeah, we're getting really close. Holy smokes. I'm going to write a piece about that because that's a good point. We're getting really close there.
And so the question becomes that, you know, what we've now with the new market environment really is nowadays, when can you trigger the systematics? Because like when systematic traders and this is where I heard Jim Carson mention it before, but the thing about a 5 to 10% market correction is not the first drop, but rather if it stays down there, then suddenly it triggers all of these systematic trading things to do a flip.
Yeah.
And that always spurs that second leg.
I think Dean Kernat from Alpha Exchange also talks about the fact that it's the second decline that really gets you because people have monetized their protection and they don't want to pay up for protection because it's expensive. So like right now you
lack of people hedge.
Right. There's a lack of people hedged. And like right now, there's a lot of folks that, you know, might be buying protection because it's cheap. But, you know, if we go down 5 or 10%, all of a sudden it's expensive. They don't do it. And then that's the one that really kills them. And
that's the thing is because of the nature of hedging, so many people live in the less than 60 days kind of time frame for a lot of their direct market downside hedging.
Yes.
And so that means that you almost like let's just use the 2022 decline as a base, but like overall the entire decline lasted 290 days, right? Like, so we're talking about a 9 to 10 month decline. And if you only started with 2-month hedges, you basically hedged out this first leg. Right. And suddenly implieds are much higher. Uncertainty as to whether hedges were required changes. And suddenly nobody has got the right hedges on during the next leg.
Yeah.
And that's to your
not only
point.
that, it became the skew really widens, and we get a situation where the downside outputs are really expensive, and it just doesn't pay. And there's been numerous studies by the sell side showing how it just doesn't pay. And in fact, a lot of the strategies that people had put in place to protect themselves during that period failed abysmally. Right? They just did not work.
Right.
So here's a question for you though, Patrick. So you brought it up earlier. OpEx, is this the turning point? And if so, do you think we just, is it 5% only? Is that what you're arguing? Like,
no. All I'm just saying is that I don't like, okay. So like based on Fibonacci's, right? Often people look for retracement, where like a 50% retraces. Now, a 50% retrace is basically a 13% decline in the market, right? In the thing. So what are the odds that a sell-off slams 13% on the downside in one fluid motion? And my argument is you can't assign a high probability of it, particularly since, like you were implying, many people on the first leg are hedged up.
yeah.
So I don't think that we go and do a 13% decline on the first leg. It will be greater than 5%. So my view is that whenever a market correction begins, we'll hit 6,200. I think 6,200 is that kind of logical place where it could be greater than 6,200, which is about a 7.5% sell-off.
Okay.
But I feel that is a very realistic kind of expectation of where a first leg of a decline could find short-term low and a bounce on there. So that's the number in my head. But obviously, the one thing that good traders do is that we adapt to what the unfolding reality is. We have to see where it starts. What is the catalyst behind it? Like there's a lot of things that can change this. So this is just a conceptual idea in a period that we're in a very strong bull market still. And we haven't seen the opening, first shots of what a bear decline is looking like, where if we started off with some kind of huge news announcement that nobody saw coming and the stock market's down 7% in one shot, well it's not going to be stop at 6,200. It's all going to be about how it begins and what it looks like when it gets started.
Okay.
All right.
But is OpEx going to be the top? Are we recording this on the top?
I am not willing to make that call, but I'm acknowledging the OpEx is a very important pivot moment, just like the Fed meeting was. And I've been highlighting specifically that it's incredibly important for us to watch this 48-hour window between the FOMC and the OpEx expiration as sort of a point of high interest. And so this is definitely a time frame from which I'm paying attention for the risk of a turn, but there is zero technical evidence that something has begun. So I'm not willing to just say, no, it's starting. Right.
Yeah, I hear you. I think I think there's a good chance, because I think nobody thinks there's a chance. Like zero.
No.
Like
I think there's no. I think there's a chance, 100%.
Yeah, but I feel like everyone has now, resigned to the fact that we're going to rally into year end. Like that's what it feels like to me. It feels like everyone is like all in, Lloyd Blank finding it 100% long, the craziest names. Yeah. It's going higher. You can't fight this. And yeah, I hear you. It just, the markets look the best at the top.
Yeah.
Right. Like, do we agree?
That's always the case.
Yeah. Like they look the best at the top,
and they feel like they can never go down.
Right. And then all of a sudden something changes. And so OpEx, I think, is a good chance. And I do think that there is that point. And then the other thing that I don't think enough folks are talking about is the fact that liquidity is getting withdrawn from the system. And we saw, like almost nobody talked about it because everyone's focused on AI and all the funness, all the fun going on in the stock market. But we saw the standing repo facility, meaning the other end of the Fed's structure to keep the Fed funds within a range. So like if you think about the reverse repo facility, it's designed to stop the rates from falling below the band. There's something on the other side called the standing repo facility, which is designed to provide liquidity when there's problems with funding. We saw it drawn down for the first time on a non-quarter end basis since before COVID. And it was a technical thing. And the guys that really understand this will tell me has to do with a big bill settlement that was, one day before, a bill issuance was one day before the previous bill came due. I get it. There's reasons for it. But having said that, we must be getting close because in the past, there was so much liquidity that was never needed. We didn't need to use the standing repo facility. We didn't see any sorts of cracks. So to me, I'm looking at this and I'm thinking, hey, wait, we're getting closer. And one of the things about when they keep withdrawing the liquidities is that they won't know it until that just kind of we go too far. Right. Like there won't be nice, easy, oh, it's obvious we've gone too far. It'll be, oh, we've gone too far and the liquidity is spiking and there's real problems.
The interesting part about you talking about that is the one thing that is a famous kind of saying that I love to always reference, which is that it's what you don't know that always kills the market. Like the things that we're talking about are things we're talking about are not going to be what turn the market. It's that thing that surprises the market that we didn't know was even a risk. Yeah. And the interesting thing is I haven't heard people talking about repo market. I haven't heard people talking about this. Like, what if the risk actually emerges in one of these things that nobody suddenly everyone has a eureka moment where nobody cares until everyone cares, and then they all care at once. And
one of the things you mentioned, the fact that it's the thing you're not expecting, or that's kind of bubbling on the background. Everyone loves passing around that Bank of America fund manager survey, and they ask people, what are your biggest concerns? And it'll be like tariffs, inflation, trade war, whatever. It'll be all the different things. And I always tell folks that whatever is the number one concern, you can ignore it, because the reality is that the market is already positioned for that worry. It's the second and third and maybe even the fourth one. It's very akin to the old Don Cox thing. It's, what is on page 17 that's on its way to page 1. So don't worry.
I thought it was page 16. I was looking on the wrong page. I was looking on the wrong page.
You and me
I
both,
was always
buddy.
looking on 16 and you and it was the 17th page. Okay.
Well done, Patrick. That's a good line.
All right. Let's quickly wrap by just talking about precious metals here for a moment. And what I wanted, actually, we could talk a few of these commodities, but one thing, gold had a little bit of a correction here. Obviously, dollar up, interest rates up, things that typically take the wind out of the sails of gold. It's up again. But what's crazy is, like, I saw this bearish engulfing candle on gold coming in. I slam on my protective puts on my GDX positions to 70. I pay up like like nobody's business, locking in 70 price. It drops to 66, 68. I'm thinking, oh, I caught the top, and look at this freaking thing. Yeah. Like, just rips to a fresh new high. Like gold miners, like look at the way, like Agnico Eagle breaking to a fresh new high. Even the platinum palladium plays like SBSW go ripping higher. Like, it's a brand new freaking breakout on these precious metals. Like, it feels like so, like this is like the hottest part of the market, and these guys are just like leaning into this again. Unbelievable.
I think the Grant Williams presentation from many, many years ago,
2016,
was it 16? When he talked about like how little institutions own gold, And if they were going to invest even a tiny little portion of their portfolio in gold or gold miners, how
pretty
much
sure
it would move it.
If Grant put his money where his mouth was, he's right now retiring somewhere on an island.
He's already on an island, retired.
Damn it. All right. Quick thing. So what was interesting is on that show I cheat on with you with
oh yeah, you have to bring it up.
There was
I thought we talked about this in therapy that you weren't going to bring it up.
Yeah, I wasn't going to bring it up, but the Louis Vincent Gav was on and talking about the reflation trade.
Okay,
and obviously a part of the reflation trade is many of these kind of commodities and things like that. So copper obviously got slammed in the face with that tariff kind of event where tariffs on, tariffs off. Trump kind of created extraordinary volatility. But what was interesting is that copper's trading at very close to its even 2-year lows, 4.25 being the bottom end of this range. But I'm shocked how copper isn't trading even remotely back to levels in a reflationary environment where it was trading before all the tariff mess even became an issue, right? Like we've had numerous times and huge amounts of volume that have traded copper in this kind of 475 to 550 area. And it's kind of stuck at its lows. It just doesn't feel that this makes sense to me. I don't think copper should be this low. I don't know. Like, how bullish are you on copper?
So I think the trouble about copper is you got to specify whether you're talking about U.S. copper,
Dr. Copper or
world copper.
I was talking Dr. Copper.
You're talking Dr. Copper.
So okay, here's the chart of grade A copper and LME, and this is what you're talking about, which is that on the LME it's trading much closer to the highs of the last year than the lows. And that's the bizarre part. Like, why is it that there's such a disparity in the U.S. COMEX?
Oh, it's because of tariffs.
No, but the tariffs are not an issue here anymore. So everything should have been
but there's always
recalibrated.
risk in tariffs and stuff
So it should be trading at a discount?
I don't know. I haven't paid that much attention to it. There's a lot of volatility.
Are you long copper?
No, I'm not. And in fact, if I was going to buy anything, I'd buy the copper miners.
Well, copper miners are doing well, but
I feel like that's going to be the next stage. Like you don't need to go and copper's become tougher to trade. Like put LME. Do you have LME copper?
Yeah, that's what I had on here. This is LME.
Oh, okay. Sorry. Yeah. So that chart looks fine. What are you worried about?
Yeah, no, but what I'm interested in here is okay. So the chart
Just
is fine.
ignore that one.
No, but
that's not a real mark. You can't.
But you know what? I know. I want to buy it. I want to lean into this thing.
Okay, well, I think you can own it. Like, buy it. Like, if anything, you're just going to tariff it again. Like, it's. But
you know what? The funny part is, okay, so what is the downside? I mean, what's your over under? Like, what kind of a probability would you assign that copper breaks 4.25 on the downside? Like, it's not probable. So what if you were to just pick a number randomly out of your head?
What is it trading at now?
It's at 460. So if you're a dealer here and you're putting on some sort of an option pricing on the downside risk for 1 year forward, what's the risk that copper breaks below 4.25? What would you assign a probability to it?
Like, I think that's going to take like a real recession. And
so what probability would you put a number?
1 in 5?
What, 20%?
Yeah, like you should always good trader in there, like
20%.
I bet you I'm closer to where the market's priced it than you think.
I personally think that there's a very good chance that low holds, and so
but 1 in 5 is not like that's not like a high probability that I think it's going down there. So
the trade idea that I proposed was going long copper here and hedging it out with a 450 by 4.25 bear put spread, which is literally trading for 2 months out for under 5 cents. under a nickel. And so you basically blunt your downside drawdown risk if you're early to the trade, and have all of the upside if it works.
There you go. These are the kind of things you learn at bigpicturetrading.com/new prices with an S. Get in there before it goes up in price.
But do you like it?
Yeah, I do.
Thanks for the plug.
By the way, you're talking about Louis Vincent Gav, and so I just want to say that he cracks me up, and he is awesome. And I was in a chat with him, and he talked about Xi, bien fooing him, Trump. And I was like, oh my God, I don't think anyone else got it. And I was like, only a Frenchman would talk about that. So Dien Bien Phu was a famous place in Vietnam. And for those who don't know, the French were in Vietnam before the US, and there was a famous battle there. And it was kind of interesting because the French got caught there, and then the Americans got caught there as well. And so what I love about Louis is that these deep cut, like, historical references that he builds into his narratives, outstanding. Like, just double thumbs up for me. Completely love the Vietnam references. Terrific writing.
All right. That's all I got.
That's all you got?
That's,
Usually you got so much to talk about.
We are done.
Oh, okay. Well, listen, folks. Thank you very much for tuning in.
Yeah.
Patrick, where can they find about you and your wonderful product? And where can they sign up for a 30-day risk-free trial?
You could go to bigpicturetrading.com /new prices
with an S.
And so with an S. Because making a new price would have been too
right.
easy.
Gotta have the S in there.
But listen, Danny's gonna have the link in the description of the YouTube, so you can find it in there as well. But thanks for the plug, buddy. But you know what? You listen. People should be getting your letter as well. And so where can they get your letter still locked in at the low inflation price pre-adjusted levels that are currently on?
Thank you very much. You can go to the macrotourist.com and listen. Bull market, bear market, we're just happy to spend some time together on this crazy ride. Now stick around for the after show. Danny, my man,
I'm slurring my words. I literally demoed this can, and I'm like, how am I gonna make it through this show?
Oh my God, you both drank it.
It is strong. Oh my God. It literally says extra strong beer.
It's got like a beaver with a hockey helmet. Yeah. It's going on. He's like,
it's as Canadian as you're gonna get.
It's the lumberjack hockey playing beaver.
Oh my God. That's
10.8.
10.8.
Okay, so we got to rate them. We're going back. We're going to be serious here. We got to do the rating. And remember, none of this amateur stuff like round figures shit. Like, you got to up your game, Danny. Okay?
Okay. Well, do you know what? Straight away, I'm going to go for a high score. Now, I know Pat doesn't like to do 10 out of 10s, but I'm different and I'm English and I like to be truthful with my answers. So I'm going to go for a 9 out of 10.
Okay, well, I couldn't push him off. I couldn't push him off the round numbers. He's just sticking with them. He's like,
I'm sticking with a 9.
Hey, screw you, Kev. We're not sticking with the round numbers. Okay, Patrick, right. What do you got?
So here's my take. First, when I took the sip, I was like, "Oh my God, this is strong." Because because you're in your brain, you have this kind of impression, 10.8. This is going to give me the alcohol kind of back taste and everything. Yeah. But throughout the episode, I'm drinking this thing like a normal beer. It actually ended up tasting great.
It's an 11% sessionable beer.
You know what? You can drink it like a wine. No, but okay. So now I tend to like to rate beers in categories. So this is an IPA. So I have to put it in the IPA category. Obviously, a strong double and triple IPA category. And to be honest, it's pretty damn good. Yeah. I'm in Danny's camp. I'm gonna give it an 8.6. I'm not gonna give it a full 9, but you know what? This is the best Hoser juice I've ever had, buddy.
Okay. Hoser juice. With an English accent. Hoser.
Yes, he's been around me too much. Hoser juice. What did I call it? Hoser juice. Yeah.
Hoser juice. Okay, I'm gonna. I can't stand IPAs, and I can't stand high alcohol beers. So right off the bat, like this was like, it was going to be lucky to get a 5 for me. And it is way, way better than I ever expected. I'm in your camp. It's almost drinkable. I'm going to give it like a 7.9.
Wow.
Which is probably the most I've ever given a triple IPA. Because usually, and Patrick is completely correct, that usually you take these things and you feel like you've like shotgun fire. Like you can taste the alcohol, and the alcohol's not that bad.
No.
So there we go. Okay, what else is new and exciting with you folks?
Well, listen, we got that beer delivery. So I had some friends fly in from Toronto, and we were talking all summer that we've been dropping the ball on our beer tasting in this thing, and I called in a favor. I said, listen, if you got room in that luggage, we need some beers to feature on the thing. And they came through. We got 10 beers lined up.
That's right.
10 beers.
Tickets to Christmas.
But no, what do you mean Christmas? We're bi-weekly, buddy. We're clearing. We're going in the new year with this beer list. But no, you know what? So we're set up. We're ready to go with a proper beer tasting. But Kev, you know where I'm going to be for the next episode of Market Hunt?
Where?
South Africa.
Oh, really? That's cool.
We're doing our mastermind out there with our mastermind group, and so we're going to Cape Town, and so the next Market Huddle session, which will feel a lot like this one, except I won't have that kick-ass sign in the background.
Yeah, what you'll see, lions.
Exactly.
Are you going to go on a safari?
We are. We're gonna take the members afterwards to Kruger Park for the weekend.
That is awesome. So listen, we need pictures.
Yeah.
Like we want pictures. Like I think that we deserve them. And if we're not going to go, we can't live the Playboy lifestyle that you live. But we want the pictures.
The safari is cool, but what I'm tempting to actually do is book one of these great white shark fucking things, and I don't know whether I don't know if I have the balls to do it.
No,
you won't do after being with a great white shark anyway. So
it's
do it, Patrick.
You think so?
Yeah, you got to do it. You're in a bloody cage. That's fine. Like that's not going to be that scary. What's going to be scarier is to go surfing.
Where the shark jumps into the cage.
Yeah, but he's at that point he's kind of messed up. He's not going to be able to eat you well. Right? Like once he's in, he's too big. He's just trying to get out. That's a disaster. I bet you that person didn't get eaten.
No, he didn't. He popped out of the cage. You're correct. He did not get bit.
Yeah, that doesn't surprise me.
But it's still enough to shit my pants.
Yeah, I get it. That would definitely be, that'd be tough.
I will do some surfing. I will.
Yeah, so that to me is scarier.
Really?
Yeah, than going and swimming in a cage.
Yeah.
Like I'd still go surfing too, but I'm just don't think about it.
Great whites don't go into the shallows, do they?
Yeah.
Don't even tell me
Patrick.
Don't even tell me this
chance. They don't like it. They
they don't like it. This is what I need to tell myself.
Yeah, they don't like it at all.
They are not going into the shallow.
They're only out in the deep water. They don't ever come into shore to eat like the sea lions and stuff that are around you. So when you see all sorts of sea lions, just go, that's okay. Those sea lions, they wouldn't be here if there were sharks.
Exactly. Just don't be a sea lion.
Exactly. Like there's nothing to worry about. As a joke, actually, when I was in PEI, I was out paddleboarding and there was like a family, like a school of sea lions. So like, of course, like an idiot, I'm like out trying to chase them, right? Like, trying to catch them. And my wife was losing her shit because she's telling me that basically that's what sharks are attracted to. And then there's sea lions, there's probably sharks. And there I am.
So you mean orcas? Orcas are the
no. There's sharks. There's great whites in PEI. I think they caught one of the bigger ones there in there once. Yeah. And in fact, there's actually an article about Halifax. There's a famous dive spot where everyone goes, and there's one that's been hanging out there, and the people that are like snorkeling are getting to see him or her. I'm not sure if it's him or her, but it's the funniest thing. They got like some ex-Marine, like 65-year-old dude came up from the southern US or somewhere in the US, and he was ecstatic about seeing this shark. He loved it. And there's like video. So Google it, like Google CBC, Halifax, great white. You can see it.
Awesome. I will do.
There you go. You do that right before you trip, buddy. Anyways,
right.
we're looking forward to pictures. Have a great time.
Thank you.
And Danny, thanks for everything. We'll see everybody next week.